Hello and welcome to this next lesson. So far we've spoken about bias. The next thing we're going to talk about is marking out key areas. This is something people overcomplicate. I want you to just look and observe this EURUSD chart on the daily time frame for just a second and try and identify what you think the likelihood is of certain candles creating points of interest on a small time frame. So for example, if we measure the entirety of this daily candles range, you can see price action came into the discount area. So this has got permission to push higher. You can see it didn't make it to this high, but we did get 1, 2, 3, 4 bullish days out of it, which is, from a daily perspective, really, really good. So now let's just see what happened in here, because price action reacted from this daily time frame. At this point on, you need to be looking at a smaller time frame to see what you can actually find. And you can see clearly price action's pushing higher, but I want to try and go a little bit deeper with this because, again, what we actually have is the candle formations. We have this low, which is obviously here. Price action closed miles above the low of this candle. So we would anticipate the next days would be bullish. If we measure the entirety of this candle, you can see price action did come down to the 50%, but actually pushed higher. If you look at where this candle actually closed and opened, because of the relationship and what happened there, we're looking to measure the wick. And what we can see is that the upper half is still respected. And the next candle is pushing higher in any case. So you're anticipating bullish price action basically until you're told otherwise. So knowing that now and basing that from these areas, there's a couple of things that you can start to see. And that is a bias on a 4-hour time frame. And within this area right here, from a daily area of inefficiency, you can see another area of inefficiency which was reacted inside. Now, I'll be honest, I just bought inside here, and that was a trade. However, you can go deeper with it as well because there's another trade you can take advantage of. But looking for a point of interest is not an overcomplicated process. You're identifying the daily swing point areas, you're identifying your bullish or bearish move, and you're identifying a stance to say, right, we're reacting inside this 4-hour area. Now we're pushing higher, sweeping that high, which is our liquidity area. It's got a 4-hour area here, imbalance here. We've seen the reaction plus a huge move higher. So with that huge move higher, after that point there, you've got another area of inefficiency. But if you go to a smaller time frame, and this was a very well documented trade that we took, you can see that actually we created the formations, so a range with this low and this high. Price action reacted well inside the discount area and then gave us a really nice trade opportunity just to take a target to that area here, that liquidity. So you can follow this the whole way. And you can see once we swept these highs, price action started moving lower. Now, if we actually observe this huge fall down, you can see a couple of things happening. You can see that this looks pretty bearish on a daily time frame. However, if we go to a weekly time frame, it actually looks pretty bullish because we are actually in a situation where we're respecting the bullish bodies of this particular area. We're in a bit of consolidation, but that doesn't matter right now. This is just focusing on the basics. This looks bullish. So on a smaller time frame, again, you've got the candle formation, which is here. We don't need it doesn't take a genius to work out what happened because that candle closed miles above this one and this one. But more importantly, it closed above the previous candle's low. So you would anticipate the next day is bullish. But just look what's actually happened on this next day. It's actually created an imbalance. And you can see the imbalance that's being created, which is sitting in here. And from that area there, you can see price action move into the upside from it. And you can then go to smaller time frames and start observing some of this price action, some of the patterns and behaviors here. Because once again, you can see that on a smaller time frame, we respected this area of inefficiency. And then we pushed to the upside again. Now, what did it leave behind? It left behind another area of inefficiency that we can utilize and a trading range. The reason that's a trading range is because you've got a 3-point formation low right here, and you've got a high, which is right here. So we can anticipate that price action is going to retrace at least back into the discount areas. But we're not talking about that right now. We're talking about marking up areas of interest. Because the truth is, this is a nice area of interest. And you've actually got two options here. Either trade it with your stop loss under this low, or go to a smaller time frame and wait for extra evidence to see if there's anything that you could do to actually take this higher. Personally, I didn't take this, and this was documented in the commentary channel, but personally, I was a massive fan because we actually came into this area and then we created this inverse fair value gap. And once we created this inverse fair value gap, that in itself was this is like a perfect trade, a generally perfect trade from a 4-hour area, from a daily area. That's an entry. And you've maintained that area, that level, from identifying your key levels of interest. That's how powerful it is when you're able to identify areas of interest after identifying the bias. If we go back over to gold, the reason I'm talking about gold from the last lesson especially is because at the moment, price action is sitting inside this area of inefficiency. This is real-time price action. The reason I'm talking about gold is because this is a real-time example. The euro trades have all happened, but you can see we're reacting here and we're actually inside this area about to get a swing low. If this daily candle closes where it is, from a 4-hour perspective, we might have a nice area of interest. That is tomorrow's area of interest. If you measure this entire trading range, it could hit the 50% and then go higher. You might not like areas of inefficiency. Instead, you might prefer inverse fair value gaps. You can use that. You might just prefer order blocks. You can use these series of down candles here. You might just like breaker blocks. You can use the breaker block. Personally, and I like either imbalances or inverse imbalances. Together, that makes them even higher in probability because that is a balanced price range. And that is like having two key levels stacked together. It's just doubling your confluence at the end of the day. So I really like it. So get used to identifying key levels of interest and areas you think price action can draw towards. Again, you had a swing high up here, and then we've been moving lower ever since. And because these candles have not actually created a candle formation low, we're just going to continue anticipating bullish price action, meaning the likelihood is we're actually probably coming for this liquidity, this low. And when we observe the 4-hour, this is an area of interest, and I believe this was the area I called out on a stream the other night. Now, price action didn't react there. Instead, it created another area. Now, that's fine, because you could be trading in here, or in fact, you could be setting a position inside this smaller time frame area of inefficiency. Maybe you just want to wait for price action to come back into the premium level and then take your opportunity. And the target is very clear. It is utilizing this low. So hopefully you guys found this insightful. If you have any questions, feel free to reach out. But otherwise, I will see you on the next one.